Hello everyone, welcome to my channel. Today we are going to speak about the company Bajaj Finance and Bajaj Finserv, and you must have noticed that both the companies have taken a heavy beating from the market in the last couple of weeks. So in this video we'll try to understand what could be the reasons for such a steep fall and whether you should hold it in your portfolio or you should exit it or you should add more. We'll try to take a look at it. Alright. Before I begin the video, let me give you a disclaimer. I do not hold any position in Bajaj Finance at the time of making this video. Neither have I recommended this particular company to any of my clients, and I do not hold this company in any of the small case portfolios that I maintain. Alright. So let me take you back to the year 2008. It will give us some context for the discussion. You can see that before the 2008 crisis started, that was in the year 2006 and 7, Bajaj Finance had made a high of 50 rupees per share, and during the crash, it came down to as low as 5 rupees per share. Now, for somebody who had invested at 50 rupees per share in Bajaj Finance, and if he decided to hold the company, he or she would have taken a drawdown of 95% on their investment value. Alright. Now, let me take you to an Excel sheet and try to show you the returns, how it would look like for somebody who had invested pre 2008. So, if you had purchased pre 2008 at 50 rupees per share, then at the current CMP of 6,000 rupees per share, the CAGR returns per year come to approximately 41% per annum. That's a very handsome rate of return, isn't it? For someone who had purchased it at the bottom of the 2008 crisis, okay, he or she would see a CAGR return of about 66% per annum. That's even more handsome than the earlier 41% that we saw. And for someone who kept on accumulating Bajaj Finance during this entire period, the average would have been about 25 rupees. That's my guess. And the CAGR return comes to about 48%. Okay, that's again very handsome rate of return. Now, just imagine for someone who has purchased Bajaj Finance at this point, or at an average point somewhere in the 25 or 30 range, how is he or she going to exit the company? Okay, because the kind of volumes that they purchased at 25 rupees per share, those were huge. And for these bigger investors to exit at the current market price, it is definitely going to create some volatility or a huge movement in price. That is why, taking you back to 2022, you see here the stock is again trying to make a similar range, and this time it is between 8,000 and probably 5,000 rupees. Alright, it has still not established a range like the one we saw during 2008. But if we take this range of 5,000 to 8,000 rupees, we may see a similar pattern that we saw during the 2008 crisis. And that time the range was huge, it was 5 rupees to 50 rupees. Alright, let us wait for the stock to establish a range for itself. Now, let me talk a bit about two important phenomena known as accumulation and distribution. So accumulation is basically that phase when bigger investors they are systematically buying a particular company, okay, and they have a conviction that this stock will go up, and they don't mind buying at 5 rupees or 50 rupees, and then they end up getting an average price which will be somewhere like 25 rupees or 30 rupees, which we saw earlier. Similarly, distribution is that phase when the bigger investors are exiting their positions, and the whole intention that they have is to exit it at an average price. Because please try to understand, if a person who has bought Bajaj Finance at 50 rupees or 25 rupees, and if is trying to sell the entire quantity here at 8,000 rupees, it is going to be extremely volatile for the share price. Okay, and it is not in the best interest of someone who is holding a huge quantity of that company. Okay, so instead of selling it at one single point, he or she prefers to sell it over a period of time. Now, this is what we call as distribution. All right. The tricky part here is that we are not yet sure whether the current phase is an accumulation phase or a distribution phase. Because if you see the chart pattern, it looks similar during an accumulation phase or a distribution phase. Okay. Taking you back again to 2008, it may very well have happened that the company would have cracked down from this level also, or it would have stagnated for the last 10 to 12 years. Okay, in that case we would have called this as a distribution phase. Okay, we would have said that somebody who has purchased it at 1 rupee, or somebody who got the stock from the demerger of Bajaj Auto, he or she is selling it, and this looks like a distribution phase. Okay, but that didn't happen, and we saw the stock price bounce from 5 rupees to straight 8,000 rupees. Okay, and that is why in hindsight we are calling this as an accumulation phase. I hope I'm able to make my point clear that we are still not sure whether this is an accumulation phase or a distribution phase. It may very well happen that after consolidation in this range for a couple of months or a year or a two, the stock it again starts going up above 8,000. And that time we will again call this in hindsight as an accumulation phase. However, if the stock keeps consolidating between this range for a long period of time, let's say 5 years, 6 years, 7 years, or it breaks this range and then consolidates at a lower level for a long period of time, in hindsight, we will call this as a distribution phase. This is the problem of technical analysis, that everything that we do in technical analysis is always in the hindsight. Okay, nothing against technical analysis. I'm just telling you the pros and cons of the field. Now, let me try to shed some light on why I feel that this is probably a distribution phase. Okay. See, there is no certainty in the stock markets, and whatever I'm saying, I reserve the right to be wrong. And I've given you the disclaimer, I do not have any hidden intentions behind making this video. So let me take you to an article that I came across. Okay, it says that RBI tightens NBFC lending, announces a slew of new regulatory changes. Now, what the article says is that the regulator on Tuesday issued four separate circulars. Number one, large exposure framework for NBFCs, upper layer. Number two, disclosures in their financial statements. Number three, scale based regulation for capital requirements, per layer. And number four, regulatory restrictions on their loans and advances. So let me take all the four articles one by one in a very brief manner. Number one, large exposure framework for NBFCs. Now, what this says is that NBFCs cannot have more than 25% of their total capital base as an exposure to one single party. Okay. Now, this particular regulation, it doesn't really affect Bajaj Finance in a very severe way, because Bajaj Finance is a retail lending NBFC, unlike some of the wholesale lending NBFCs, which have huge exposure to particular parties. So Bajaj Finance is kind of protected from this particular change. However, coming to the second disclosure, which says that disclosures in their financial statements. Now, this affects all the NBFCs, whether it is a retail NBFC or a wholesale NBFC, because NBFCs now have to give more disclosures to their investors. Number three, scale based regulation for capital requirements. Now, what this means is that the regulator has increased the amount of tier 1 capital required by NBFCs. Okay, the regulator now wants the larger NBFCs to play it safe rather than chasing growth. Okay, so that is why it says scale based regulations for capital requirements. Now, at this moment, let me compare NBFCs with banks. All right. So, in the last 15 to 20 years, NBFCs have grown at a tremendous rate, and if we compare it with the growth rate in banks, we would see that these rates are much larger than what the banks have grown. So one of the reasons why this has happened is because banks have been tightly regulated by RBI, whereas NBFCs were pretty loosely regulated by RBI, because the RBI had financial inclusion in its mind. Okay. Now, what is financial inclusion? It basically means that a customer who is not able to get a loan from a bank, he should be able to get a loan so that he or she can do better things in their lives. Okay. And that is why the whole concept of NBFCs, it started getting popular, because people needed credit. Okay. So the unbankable people, banks, people to whom the banks were not ready to lend, so NBFC stepped in and they said that okay, we will lend them. And because the NBFCs were taking a bigger risk, the RBI gave them some relaxation by having the regulations looser than the regulations for banks. However, Now in 2021 and 22, the scenario seems to be changing with these, these regulatory changes which the RBI has made. Okay, and the final change is regulatory restrictions on their loans and advances. So this is again one regulatory change which is taking the larger NBFCs closer to the banks. Okay, now let me show you the valuation of Bajaj Finance. This is ratestar.in. It's a portal that I frequently use. No endorsements. Alright, so if we take a look at the price to book value ratio of Bajaj Finance, it still trades at about 7.69. And if I take a look at the historical price to book value ratio, it has crossed very well above the 12 mark also. Now, to give you some, reference around this, an NBFC with a market capitalization of 3,69,000 crores, that's almost 4 lakh crores, trading at 8 times the book value. It is a very, very high valuation. Now, why the market decided to give such a steep valuation to Bajaj Finance? The answer is growth. Because if you take at the 10-year revenue CAGR of Bajaj Finance, they have grown at about 25%. And similarly, the numbers reflect in the profit growth. Now, these numbers are extremely good and they are almost three times the GDP growth rate. All right. However, if you see in the last 3 years, the growth seems to have moderated. And why has the growth moderated? Because the RBI has started putting more regulatory requirements on these NBFCs. Okay. Now, if we compare the valuation of Bajaj Finance with something like a HDFC Bank, you will be able to see a stark difference between how market treats a bank and how market treats a large NBFC. So HDFC Bank is not probably, it's definitely India's most successful private sector bank, and it has created huge wealth for investors over a period of last 25 to 30 years. And if we take a look at the price to book value multiple of HDFC Bank, you would see that the market consistently rates it somewhere between 3 to 4 times the book value. And whereas in the case of Bajaj Finance, we saw that the market was ready to rate it at about 10 to 12 times the book value. Okay. So it may very well be happening that the market is actually de-rating Bajaj Finance because of these regulatory changes. Okay, and one more change which I observed and which the entire world observed is that HDFC Bank has decided to reverse merge HDFC Limited with HDFC Bank. Now, a little bit of story behind this change is that HDFC Bank was actually born out of HDFC Limited, which was the only holding company or the only company which HDFC Group had when they began operations. Okay. However, over a period of time, the growth rate in bank was more than the growth rate in HDFC Limited. Okay, and bank it came up with various subsidiaries like HDB Financial is a subsidiary that they have. And then HDFC Limited had a subsidiary which is HDFC Life, which got demerged and which got listed. So HDFC Limited as such has created huge value for their shareholders in the form of setting up new businesses and then making sure that every business is being run independently. Okay. So recently we saw that HDFC Bank and HDFC Limited got merged. Now what could be the reason? In my opinion, one of the biggest reasons could be HDFC anticipates that the RBI is going to tighten the restrictions more for NBFCs. Okay, so it doesn't really make sense for them to have two separate companies. Okay, because HDFC, which had relaxations earlier, is now going to be treated by the regulator almost like a bank, and the regulator may eventually want that these NBFCs they convert themselves into banks. And HDFC being HDFC, they proactively took a decision of reverse merging the NBFC operations with the banking operations. So that's all I have. That's why I feel that this is probably a distribution phase. I wouldn't predict any price levels as usual. I don't believe in predicting price levels. However, if we take a long term view on what's happening with the stock, it doesn't seem very rosy at the moment. All right, that's all I have. Thank you very much. If you like the video, do press the like button, subscribe to our channel, and do not forget to check our small cases. Thank you.